The next thing which we'll look at is the foreign exchange risk, especially when international transactions are involved. And how do you really get into a hedging position for the foreign exchange kind of a risk? See, typically, whenever we talk about the forex risk, the first thing that comes out for us is identifying the exposure. Exposure is nothing but long versus short, or how much assets we have in a foreign currency versus how much liabilities we have in the foreign currency. Assets are nothing but how many loans you have given from a bank perspective, how many loans they have given for the foreign customers is their asset, how much borrowings they have done, or probably if I look at a typical Indian bank, how much loans they have given to US customers is their asset portfolio. US asset, USD based assets. How much borrowings they have done in USD, their USD based liabilities. So in a particular foreign currency, I'll find out for any person, even for us, right? If I talk about how much investments I have in dollars, investments could be in the real estate there, or could be in the stock markets there, could be the bonds there, whatever, dollar denominated. In dollar denominated, how much of assets I have, and in dollar denominated, how much of liabilities I have, which are borrowings, right? So the net of these two is what we call as exposure for that particular currency, right? So probably if I have properties and all worth $50 million, right? But I have taken the loan in the US market alone. In the US market alone, let's say I have taken a $45 million loan. What I can very well see is I have an exposure of $5 million, which is as good as I have borrowed 45 million in the US market and invested somewhere, which right now has become around 50 million. So my exposure is 5 million positive. That is what we simply call as an exposure. So when we say we are positive, net is we are long in a currency, because I have more in terms of dollars. Dollar assets are more than dollar liabilities for me. That is what we call as we are net long in a currency. The positive is a reflection of being net long in a currency where assets are greater than the liabilities in that particular currency. Now, what is the risk for us? If the foreign currency appreciates, $1 becomes 66 or 67, we are very happy, right? Because my assets are more, my dollar denominated assets are more compared to the dollar denominated liabilities. As a Indian rupee hold, if my domestic currency is Indian rupee, my dollar denominated assets will be more than my liabilities, which means if the dollar appreciates and rupee depreciates, my profit is increasing, right? Because $1 becomes 67, 68. So probably I have $5 million benefit. $5 million into 68 rupees, 70 rupees, 80 rupees what is the benefit which I am going to receive? So when I am having a net positive exposure, the foreign currency appreciation and domestic currency depreciation will actually benefit me to the largest extent. Whereas my risk is the other side. If the foreign currency depreciates, I'm actually getting into a loss, right? The same is the opposite if my exposure is net negative. My assets are $45 million, my liabilities are $50 million. So my net is minus $5 million. So if I translate it again to the Indian, if my rupee appreciates or if the dollar appreciates, I'm losing very, very heavily. My loss is increasing. Whereas if the rupee appreciates, probably my loss is decreasing. So first thing we have to understand is for each of the foreign currencies, the way I have to look at the foreign exchange risk is, for each of the foreign currencies, am I net long on it or net short on it? Right? Net long means probably foreign currency appreciation is more beneficial to me, domestic currency depreciation is more beneficial to me. The risk is the other side. But if I am net short on any currency, we have to do this exercise for each and every currency where we have either borrowings or lendings, right? Investments or borrowing. So here in this case, if we are net short in a particular currency, obviously the domestic appreciation is good, foreign depreciation is good. But as a risk, right, we are not talking about profitabilities and all here. We are more of a risk management professional. So the intention is to reduce the risk. Both of them are risky only. In both cases, on one side there is a profit, the other side there is a possibility of a loss. So in both cases there is a possibility of a risk. So our intention is always to mitigate that risk altogether by doing some kind of mechanism. The hedging strategy will look at it. But by getting into some kind of a mechanism, our intention is to reduce our total exposure. Now, where all the forex risk can come, one, your assets are more than the liabilities in the foreign currency, or look at your purchases. See, this year you have purchased more in foreign currency, which is again adding up as an asset. I mean, if you literally translate it into the balance sheet language, any purchases you are making, if they are a long-term kind of purchases, they are as good as assets. So, are any expenses you are incurring, or any sales you are doing, they are as good as your liabilities in the long term. So, what we are saying is, if your purchases in the foreign currency are not offset with the sales, means you have purchased a raw material of so much from abroad, but you have not sold enough in abroad. Probably for a typical Indian company, raw materials it is importing, whereas sales it is doing locally. It is importing the raw material from abroad, assembling the product in India, and it is selling in India. It is exposed so much to foreign exchange risk, right? Because its raw materials, they are very much exposed to foreign exchange risk. But because the sales is in domestic, you may have to fix the price of the sales. So it may so be possible that the sales revenue price is not changing, but the cost of the raw materials is changing because of the exchange rate. And if it is going against your case, even you will end up into a loss. But you look at it the other side, you are taking the raw materials from US, assembling it. Assume that you are selling back the product to US, right? Your foreign exchange fluctuation is very much, the risk which you are facing because of the forex fluctuation is very much minimized. If your raw material price goes up, even your final sales price also will go up. So the kind of loss you are getting is pretty much minimized. So you have to make sure that the combination of the assets plus purchases in the foreign currency should be neutralized with liabilities and sales in the foreign currency. That is where we talk about the net exposure. Two aspects. One is whatever the properties, and probably the best way to talk about your current account and capital account. From a country's point of view, if I am looking at it, this is working more from those lines. Look at it in a slightly micro company level kind of a perspective. In a foreign currency, assets versus liabilities. What I am holding, what I have borrowed. In foreign currency, that is more in line with your capital account. Whereas the others, purchases and sales, which is like imports and exports. If I am looking at it from one single company standpoint, even that is an exposure to your foreign currency. If these two are not balanced properly, you are having a potential exposure in a foreign currency. Right? Now, one way to look at it is always match these two things. If that's the case, then probably there is no job for a risk manager. Right? Probably if I borrow 50 million in US market and lend 50 million in the US market, what is the benefit I am getting there? Right? Or probably if I import 50 million and again export 50 million, what is the benefit that I am getting there? So that's a scenario where there is a zero risk kind of stuff. You are least bothered about the fluctuation in the foreign currency. If your assets match with liabilities always, but in real world, those things may not happen at all, which means you are taking some level of risk in some form or the other. For that, and it may very well be possible that when you are getting into an opposite trade, it may work out, it may not work out also. Right? Probably you are able to borrow 50 million in US dollars, but you are not able to lend 50 million in US dollars. Or sales versus purchases. All possibilities can very well come up. So that's where when we talk about the Forex trading market, it's something which is more a facilitator, right? Buying and selling of the currencies. You can take positions. You can offset your risky positions. You can convert your exposure to dollar. You can either bring down or bring up by entering into a foreign currency market without typically touching your assets and liabilities. You can initiate some kind of trading transactions on the foreign currency markets in the futures segment or in any of these derivative segments, and you can try to match your assets not with the liabilities but with the trades. Right? Probably if you are so much long on, see, if your net exposure is 5 million positive, there are two ways which you can try out. Okay, probably borrow 5 more million, make net exposure as 0. You borrow 5 more million in the US market, make the net exposure as 0. Or the other way is, for that, let it on the balance sheet, let it remain as $5 million difference, but try to hedge that risk by entering into a forward contract or a futures contract or some other contract on a derivatives exchange. Right? So, I mean, the simple ways of trading in the Forex market, you can either offset your current exposures, you can get in as a hedger in the Forex, just like any commodities market or any other market. The Forex market also gives all these kind of scenarios. You can enter as a hedger, you can enter as a speculator, you can enter as a dealer, right, who is arbitraging or not even arbitraging, who is actually connecting the buyers and the sellers. You can enter as an arbitrager. All kinds of scenarios are just like your typical commodities market. Even a foreign exchange market also will work more or less in the same way, right? And of course, if the currency is fluctuating drastically, your exposure is also much higher. Like in the last 1 week, the rupee against a dollar has fluctuated like anything. If that is the case, whatever the assets you have, whatever the liabilities you have, even if there is a small difference between the assets and liabilities, you are going to suffer a loss in a big way if things are not going in your direction. Otherwise, you may gain in a big way if things are going in your direction. But both of them are very much possible, right? So that is where we always look about hedging. And when we are talking about hedging, there are two scenarios. Either I do the hedging on balance sheet. There is one thing called on balance sheet hedging, off balance sheet hedging. Simple logic. If I am talking about on balance sheet hedging, the initial scenario which I was discussing, if your assets are 50 million, make your liabilities also 50 million. For each of the currencies, right? If you have borrowed 50 million in US dollar, if your lendings are only 40 million, lend for 10 more million, or probably pay off 10 more million. Make assets equal to liabilities. That is what is a on balance sheet hedging. So overall, when I look at a balance sheet with respect to each and every currency, I'll see that for the same maturity period. Even the maturity period, I'll keep it the same. Borrowing for 20 years, lending also for 20 years. So no scope for any kind of a risk. Whatever the foreign currency exchange rate goes to, I'm least bothered in that transaction. Whatever the gain I get here is offset by the loss which I'm going to get here, or vice versa. Right? So that is what we call as a on balance sheet hedging kind of a scenario. Whereas, so that's where we are talking about a financial institution is matching the maturity as well as the currency for every foreign currency. The date as well as the amount. Both of them are matched with respect to the assets and liabilities, because that strategy will not give any kind of a benefit. Zero risk, zero return kind of a strategy. People don't want to get into those kind of strategy. So they sometimes feel it's better that we remain a little bit unhedged on the balance sheet. Probably let there be 50 million in asset, 40 million in liabilities. If at all something is required to hedge, right? Probably if you are expecting that the dollar will appreciate, if you have strong confidence that the dollar will appreciate rather than depreciate, why not take that extra advantage? In case it goes down, probably you can look at some other covering option. But if it is going to appreciate, why not take an advantage of that? So sometimes, most of the times what people do is, they don't go for an on balance sheet kind of a hedging. They go into off balance sheet type of an hedging. When we are saying off balance sheet, I will not borrow loan for the remaining 10 million. For that 10 million worth, I will actually enter into a forward market transaction. Forward market transaction on the exchange rate market. Right? How will I do that? Let's look at the scenario. Let's assume something like this. A person has borrowed $100 million in US at 5% interest and lent 25% of it in USD for the US customers only. So at 6.5. Whereas the remaining, he has lent it in INR at 10% per annum. So currently the exchange rate is 64 rupees per dollar. So now I want to see, if the exchange rate goes to 70 rupees a dollar, what is the kind of benefit? If it goes to 60 rupees a dollar, what is the kind of a benefit? Right? So within 1 year. So let's look at the scenario. Now what are his assets and liabilities if I look at that scenario here? So let's look at in foreign exchange currency, his assets, and when I am talking in liabilities. So in assets, probably $25 million he has lent in US currency itself. So $25 million he has lent at 6.5% interest, and remaining $75 million he has lent at 10% interest in Indian currency, where the dollar is equal to 64 rupees, $1 equal to 64. Whereas when I look at his liabilities, he has borrowed everything in US dollar, 100, probably at 5%. Now I have to see at the end of 1 year. At the end of 1 year, he has to pay back to his bank where he has taken the loan of 100 million. So probably he may end up paying 105, 5% interest. So he has borrowed it there and he has actually paid off here. Now let's look at this scenario. The remaining 75 million dollars he has lent in the Indian market. So $1 equal to 64. So overall, how much did he lend? I can very well say he has lent these many million in the Indian market. 4,800 million is lent in the Indian market, which means probably assuming a 10% return. So today I have lent 4,800 million rupees in the Indian market, because 75 million at the today's exchange rate is as good as I have lent 4,800 rupees in the Indian market. So after 1 year, how much will it going to fetch, assuming no defaults and all that? After 1 year, it is going to fetch me, something like this. 5280 million is what it is going to fetch, right? So assuming the interest rate is still 64 only, even after 1 year also. Even after 1 year also, let's say the interest rate is 64 only. What is happening? This, if I am converting it into Indian US dollars, I am going to get 82.5. So the return in this case is how much? Probably 82.5 minus 75. Because I have invested 75, I got 82.5 divided by 75, which is giving me a 10% return. So my overall, what is the benefit? By 75% of my money fetched me 10% return. 25% of my money fetched 6.5% return, right? So overall, how much did I get for 75% of my money? So 25% of my money fetched 6.5% return, plus 75% of my money fetched 10% return. So overall, I got 9.125%. If I had lent that money in, from my loan, I have to pay only 5%. So 4.125% is my net profit in the whole transaction. If the exchange rate is going to remain at 64 only, even after 1 year, my net benefit by lending in the Indian market is around 4.125%. 25% in the US market, 75% in the Indian market. My net benefit is around 4.125%, because my overall benefit is 9.125. But out of that, 5% I have to pay to my bank. So remaining 4.125 is my net benefit altogether. But let's assume that the dollar rate has actually gone up to 70, not 64. The dollar has gone up to 70. My net profit is only 2.05%. Whereas I have to pay to my bank 5%. I am net at a loss of 3%. See, because my $75 which I have invested, it has translated into 4,800 million rupees. After 1 year, it is going to fetch me 5,280 million rupees. At the rate of 70 rupees a dollar, if I am converting it back to dollars, it is coming out to $75.42 million. So which means I have actually invested $75 million. It has become $75.42 million. So overall, I got only $0.42 million profit, which has translated to only 0.5% profit, 0.57% profit. So 75% of my money was giving 0.57% profit. Some 25% of my money was giving me 6.5% profit. Overall, my profit is only 2.05%. Whereas my bank loan is 5%, which means I am losing out on 3% altogether in this kind of a deal. If the exchange rate goes to 70, I am losing out in a very bad way. Or probably even if the exchange rate goes to 68, if the exchange rate goes to 68, still I am bad, 4.27. But I have to pay to my bank 5. So even if the exchange rate goes to 68 on that day, I am pretty much in a loss. Whereas if the exchange rate goes to 60, If the dollar depreciates, I'm very, very happy in this case. Because 14.62 and only I have to pay 5% to my bank. So 9.62 is my outright profit in the transaction. Right? Now, where is the loss coming up for us? Now we'll talk about how do I do a off balance sheet hedging. When is the loss coming for us? When the foreign currency is appreciating. In this transaction, the loss is coming to us when the foreign currency is appreciating. So if it goes to 68, right? If it goes to 68, I am losing out. Now, from that standpoint, what I can do, now I have to freeze it. Right? Now I have to freeze it probably at 66 or 65. I'll freeze it, which means I'll enter into a forward contract. Where I can sell rupee. And buy dollar. I can sell rupee and buy dollar at 65 rupees or 66 rupees a dollar. If I enter into that kind of a transaction, now I am freezing my, let's say instead of 60, I am saying 66 or something. Yes, 6.62, and I am getting my 1.62% profit altogether. So if I can enter into a transaction where I can sell rupee at 66 rupees. I can sell rupee at 66 rupees a dollar. Buy dollars by selling rupees. So which means I will short in the foreign currency market. Today itself I will short the rupee. I will enter into a forward market where what is the transaction I will do? I will short rupee at 66 rupees a dollar. This is the transaction. Now, what is the whole flow? Let's see. I am borrowing in dollars at the current rate. So let's look at the steps which we will do. 1, borrow in dollars. Whatever that 5%, blah, blah, blah. Whatever is the interest rate, you borrow in dollars. Using that much money, dollars, buy rupee in spot market. Which means at the current 64 itself, I'll buy rupees worth whatever the dollars I have taken, $175 million or whatever it is. For that amount, I am trading in the Forex market where I am going long on rupee in the spot market. Now simultaneously what I am doing, I will short rupee forward. In the forward market, I'll short rupee where the maturity is 1 year and the price is at 66. If I am assuming that the rupee is going to depreciate even more further. If I am expecting that the rupee is going to depreciate even more further, what I'll do, I'll short rupee for that same amount. For what amount? I will not short it. See, okay, I have bought 75 million into 64. So how much was it? 4,800 million. And I am assuming that this will definitely give me a 10% return. So even adding that, I will short for these many rupees. I'll enter into the futures or forward currency market, wherein I'll say short 5,280 rupees, 80 million rupees in a 1 year forward market at 66 rupees a dollar. Now, by entering into this transaction, I am freezing my, now what will happen on that day, irrespective of whatever is the market price, market exchange rate, I will be able to sell my rupees, assuming that I have got all my rupees from the lending, whichever I have done in India, because I have bought those many rupees. Now, what I will do with those rupees, I am confident that I can lend it at 10%, assuming that part is a safe part. I am assured that I will get my 5280. So my only limitation here is, when I convert it into dollars, what if the dollar exchange rate goes to 70 after 1 year? So that is where I am playing a forex hedging, and here I did not hedge on my balance sheet. I have hedged my risk by entering into the forward market transaction. I have found that there is a forward market transaction that is available where I can enter as a short position at 66 rupees a dollar. And there is some counterparty who is willing to enter into that kind of an opposite position for me. So assuming no risk at any layer, again, those are all assumptions. Assuming that no risk is there at any layer, no defaults happen at any layer, I am assured of this much 66. If I, whatever may be the interest rate, probably if the exchange rate goes to 60, I might lose out in a big way. But here we are not bothered about our loss or whatever. We are more bothered about the accuracy, assurance. So what we are saying, okay, if it touches 60, 66, probably this gives me 6.67, and overall it is giving me 6.625% return. Right? If it is giving me 6.625% return, anyhow I have to pay back to my bank only 5%. So 1.625 is my assured profit in the transaction. And if at all I am able to freeze it at probably 65 or 65.5, it is even more giving me a little bit more extra kind of a benefit. So on the balance sheet, they are still 25 and 75 in two different currencies, 100 here. But in the foreign exchange market, I am trying to do the hedging in the appropriate position. This is what we call as off balance sheet kind of a hedging. So this is how we can create the hedging part, wherein you can mitigate your risk. Again, whenever you are doing a hedging, you have to believe in this concept that you have to compromise on your profits also. Probable profits, you have to compromise on them. Right? If you have not hedged, probably you may get a very high profit or a very high loss. But because of the hedging activity, your losses will come down and potential profits also will come down. But as a risk manager, our intention is always to take a calculated profit rather than completely opening up to heavy profit and heavy loss kind of a scenario. That is what will cause a big damage to the company. So this is where the interest rate parity theorem also comes into picture. The change, how do I decide at what price I should enter into the forward market? Right? That is where we are saying, go with the interest rate parity kind of an example. The change in the exchange rate will be primarily dependent on the change in the interest rates between the two countries. So that's where earlier also we have seen the typical rate is S0 into e power r minus rf into t. Right? Sometimes if we are talking, this is when you are doing a continuous compounding. Sometimes, again, in this chapter, in this book, here he has brought out with a discrete compounding, because the books which are used for both these purposes are two different books. Right? Probably John C. Hull is used in the earlier chapters where we discussed interest rate parity. Here some other book is being used for discussing the same interest rate parity. So, I mean, doesn't matter. The values don't differ too much. 1 plus R domestic by 1 plus R foreign into T. Which is, I mean, you remember only one formula. It does not matter at all. Right? Both of them will lead to the same. Probably I'll show that difference for you. How much difference can it come using the two different formulas? Let's say today the exchange rate is 64. Right? Let's assume that the interest rates in India are 8% and interest rate in US is some 5%. Right? Now, if I go with the continuous compounding, S naught, the exchange rate after 1 year, S naught into e power R minus RF into T. T is 1. R minus RF into T. So, the exchange rate should become 65.94 after 1 year. If the interest rates in India are 8% and the interest rates in US are 5% at this moment. So, after 1 year, the exchange rate should become 65.94, going with that assumption. But if I am going with a discrete compounding, 64 into 1 plus domestic R into T divided by 1 plus foreign R into T, because T we are talking of 1 year itself, 65.82. There is a small difference, but probably this is for a 1 year period we are talking about. But for a shorter period, even the difference will be even more negligible. 6 months, 3 months, the difference will be even more negligible. And you will not have scenarios where this much close packed answers will be existing. So probably you can use either your continuous compounding or discrete compounding kind of mechanism. So typically, when you are talking about hedging on the foreign investments, you are typically finally converting it into the return on your domestic investment, like in the earlier example, 6.65 or 6.75%, or probably 1.65% extra or 2.23% extra. Always you will convert it into your domestic. See, so basically, as long as the exchange rate is going to be, I mean, the risk-free kind of an exchange rate, the arbitrage-free kind of an exchange rate is going to be 65.94, right? Probably if there is a forward that is available at 66, better enter into a selling. If there is a forward available for, I mean, the forward rate is only 65.5, better enter as a buyer. You buy the foreign currency now, because you can get it at 65.5 only after 1 year. As per the logic, it has to go to 65.94. But the market right now is ready to sell dollar at 65.5 in the market. So better enter as a buyer. But if the forward rate is available at 66 or 66.5, better enter as a seller in the market, where you can actually lock in your profit quite comfortably. In the earlier case also, we have seen that there is a profit that can be locked up by entering into that 66 kind of a number. If I am entering as a short position in the forex market at 66, I have locked in a little bit of profit. But if I were able to enter at 65.5, I was able to lock in a higher profit as a short in the market. So these kind of strategies will help us to typically lock up the profit. If I am doing a complete balance sheet hedging, there is no scope of making any kind of a profit also. Okay, risk is zero, the return is also zero. But here we are taking a little bit of risk based on our understanding of the movement of the market, and based on that we are locking our return, though it's not a significant return, but we are still locking a return which is slightly more than how much we have to pay to our bank, right? So even the same scenario can be created in the forex, portfolios market also. Probably this is a very important point which has to be observed. See, the interest rates, domestic market and the foreign market need not move in the same direction. Indian interest rates may go up, but US interest rates may come down, or vice versa can happen. Similarly, stock markets. In Indian, the stock market may go up, whereas US stock market may fall also. So you don't observe perfect correlations in all these kind of markets. And a simple concept of portfolio is wherever the two markets are not perfectly correlated, you combine your investments in both the markets, wherein you can reduce your overall risk. That's a typical definition of a portfolio itself. You spread diversify your investments in various instruments or markets or securities, wherever there is no perfect relationship between them. Because if there is a perfect relationship, if this gains, even this also gains. If this loses, even this also loses. Right? But when you say when there is no perfect relationship, there is a possibility sometimes if this is losing, this will gain. If this second one is losing, the first one will gain, which might reduce your overall loss in the entire transaction. So that is where, because of non-perfect correlation that is existing between the domestic and the foreign interest rate markets, between the domestic and the foreign stock markets, it is advised that you can diversify your entire portfolio by maintaining some international portfolios, right? By lending some portion of your money in US market, by investing some portion in the US stock markets or probably UK markets, by investing a portions across the various geographies, the overall risk can very well be diversified. That is what is the typical intention of portfolio risk reduction using this forex kind of a transaction market. Correct? So the major aspect in this chapter is primarily identifying the exposure and using the various, the off balance sheet kind of a mechanism. How do you reduce that exposure? Depending on whether you will be losing if the exchange rate goes up or you will be losing if the exchange rate goes down. Depends on your net. Now, what was your net exposure in our numerical? Your liabilities were 100 million in US. Right? Okay. We were looking at from the perspective of US because we had compared our returns from a US investor standpoint. So liabilities are zero in India. Right? India should look like a foreign, because I have borrowed in the US and finally when I have computed my returns, I have computed in dollar returns. So basically my liabilities are zero in the Indian market, whereas my assets are 75 in the Indian market. In that example which I have given, liabilities are zero in the Indian market, 75 in the assets are 75 in the Indian market. So I have a net positive exposure there for the Indian rupee. Net positive exposure, the benefit is always when the foreign currency appreciates. For me, the foreign currency is Indian rupee. When the Indian rupee appreciates, there is a benefit. When the Indian rupee depreciates, I will lose. So my hedging should be to make sure that the Indian rupee does not lose. Indian rupee does not depreciate. That is where I am taking a position of selling the Indian rupee at 66. Because if it falls to 70, I am losing overall on my value. So depending on whether I am net long or net short in the foreign currency, net exposure is positive or negative in the foreign currency, I will either sell the foreign currency or buy the foreign currency in the forward market to hedge my risk. That's the major thing which we have to be comfortable with. Depending on whether we are net long or net short in a particular foreign currency, we will take an appropriate position in the forex market, in the forward market for the exchange rates to hedge our risk altogether.